Good morning. Today we're going to start our discussion with chapter 11, and today we're going to be discussing chapters 11, 12, and 13. Chapter 11 is going to deal with long-term debt financing. Chapter 12, equity financing and securities markets. And chapter 13, capital structure and the cost of capital. So let's get started and begin our discussion with chapter 11. As we start the slides for chapter 11, the very first slide, the parent slide, number 1, the very first line that you see there says businesses need capital. When we talk about capital, another name for that is money, to buy the assets required for mission accomplishment. Basically what that says is you can't run a business without money. Money is everything, okay? A business is not a business if it doesn't have money to keep it operating, functioning. So you may have customers who are interested in buying goods from you. That's all fine, well, and dandy. However, it's going to take money to keep you operating in order for you to accomplish those things that you have set out to do. So when we say mission accomplishment, as I stated before, the things that you have set out to do, it takes money to be able to buy those things. Slide number 2, the cost of money. Of course, with money, there's always something tied to that. So what do I mean by that? There is always interest, or shall I say interest rate, tied into money, especially when you go to borrow money. There is taxes tied into money, okay? One of the four of the primary things that pretty much influence interest rates, because you know an interest rate on slide number 2 is pretty much a debt security on whatever it is that you are purchasing, investing. But 4 of the main factors is investment opportunities, that influences your interest rates. Your time preferences for the amount of time that you need the money influences your interest rate. So like say for instance, if you needed to get a loan for like 20 years, 25, 30 years, depending on what your interest rate is, that determines what a monthly payment would be for you, how much you're looking at interest over a period of time, because you're going to accumulate that interest. And for a lot of banks, loan companies, interest usually starts like the very next day. Okay, so like say for instance, you go and get a loan today, starting tomorrow, you start accruing interest. Risk is another factor that influences interest rates. And then inflation expectations. So when we talk about inflation expectations, we're referring to the economy. Okay, and we all know that it inflates up and down. There's no consistency with it. Just like gas prices, gas can be doing good for a little bit. As soon as the summer months hit, you're going to see a spike in gas. Even now, as soon as the summer months really hit us, you'll see it. You know why? Because gas goes up for a variety of reasons. A lot of times gas goes up because they know people are traveling. So guess what? It's a way for the economy to get a boost in gas pricing because, oh yeah, people are traveling. They're doing family reunions. They're going to the beach. This would be the perfect time to do that. However, if it's a period of time where they feel like people are not traveling as much, usually they'll try to drop the prices on gas. So that's kind of one way to kind of look at it. There are what you call long-term instruments, slide number 3, in relation to long-term debt. Those things being number 1, term loans. Okay? A term loan is a long-term debt financing that is obtained directly from a financial institution, often a commercial bank. I'm going to say that again. A term loan is a long-term debt financing obtained directly, long-term debt financing obtained directly from a financial institution, often a commercial bank. So basically, what a long-term loan is this. It's a contract in which you, the borrower, because you're the borrower, is where you agree to make a series of interest and principal payments. So when I say that, just to kind of give you a review, when you say interest and principal, say for an example, you have a payment that is $200 a month. And let's say for an example, okay, I'll use a credit card for an example because students usually understand that one a little bit better. Say you have a credit card that has a balance of $200. Let's say your monthly payment is $25. Depending on what your interest rate is, that $200 balance may take you 6 months to a year to pay off, if you only pay the minimum amount due. So let me tell you about the minimum amount due. So you're looking at, oh, I only have $25 that I have to pay every month. Oh, that's great. No, it's not. Because what you don't realize is that out of that $25, so much interest comes off the top. So when you're sitting in a payment of $25, depending on what your interest rate is, you have to, because remember what I said, when you have interest rate, that interest accrues every day. Now you have some people or some places like car lots, they'll run a promotion where they say, oh, no interest, like interest free for the first 6 months. That just means that for the first 6 months that you have the vehicle that you purchased, you won't have to pay interest. You're going to still pay your payments, but you won't be paying interest. But what you don't realize is a lot of times that interest is tacked on to the end of the loan. Okay? Whereas if you took a loan from a bank, that interest is going to start accruing the very next day. Okay? You're going to start accruing interest. When you pay $25, keep in mind from, let's say for instance, your due date is like the 20th of each month. Okay, so from the 1st of the month to the 20th of the month, you accrue an interest every day. When you make that $25, whatever your interest is that you have accrued for that last period, payment period, that's going to come off the top first. So we're just going to play with some numbers. Let's just say that interest is $10. When you sit in $25, $10 going toward interest. So how much is left to go toward the principal? The principal balance, the part of the loan that is the actual what I borrowed out, not including the interest, that's only what, $15? So when you sitting in $25 a month, but only 15 is actually going toward the balance. See, the principal is the actual balancing of what you owe on the loan. All that other extra, that's interest that over a course of period of time you owe. So whereas you may have a balance of $200 and let's say it may take you 6 months to pay that, in actuality, you would have really given them over that 6 month period, you would have really paid back $250. We're just playing with numbers. $250, $275. How is that? Because a bulk of that was interest that you paid. How do you get over? How do you get around? When that next statement comes out and it says you owe $200 and the minimum you have to pay is $25, you don't do that. If you want to knock a lot, because the way you knock out interest, like clear it out, you pay lump sums. Because guess what? If the minimum payment is on $25, but you send in $100, you have just knocked off up front so many days of interest that you don't have to worry about on that loan that you're having to pay back. Okay, so that's the correlation between interest and principal payments, interest and principal payments when it comes to loans. A lot of time, whatever your minimum payment is, and that's all you pay every month, very little of that is going to go toward the principal. So if you really want to knock down the balance and really chime into that principal and not just be paying so much on the interest, you're going to have to pay lump sums. It's almost one of those things where if it's $200 at the end of the month, pay the $200 and then start it over again. That's so what you desire. But that's what a term loan is. It's where you, being the person borrowing the money, you agree to make a series of interest and principal payments on the specified dates to a lender. They can be negotiated. Term loans can be negotiated between whoever is the borrower or the borrowing business and the lender. Okay, and again, that can be the lender. I'm speaking in reference of can be a financial institution such as a commercial bank, a mutual fund, or an insurance company. Most term loans have a maturity date of 3 to 10 years. Most term loans have a maturity of 3 to 10 years. Okay. Now, because you got to understand, we're not talking about a house mortgage loan or, we're talking about business loans. So just know that we're talking business wise. We're talking business loan. Okay. Now, term loans have 3 advantages over debt bonds. Term loans have 3 advantages over debt bonds. The first advantage is speed, like how quick you can get a loan. You just can get a loan faster than you can a bond. Flexibility, that's in your terms of the loan. Because a lot of times you have that ability after so many years to refinance and perhaps get a cheaper interest rate, which will affect your payment every month. You can get an interest rate that'll make your payments lower to make it comfortable for you to pay every month. Or you can actually get an interest rate that'll make your payment low, but you may want to double up on the payment so you can go ahead and pay it off. Okay, and then the third advantage, low administrative costs. Now, sometimes rates on a term loan can either be fixed or variable. So now if it's a fixed rate, it's going to be one of those rates that's pretty much locked in. Now, if it's a variable rate, and some people do that, where they'll have a particular rate for so many years, go back, renegotiate, refinance, and maybe get a different interest rate. That's not something that I would recommend or prefer, but I guess that would be pretty much left up to the business as to how they wanted to handle that. But the only thing about variables is, it's not going to be consistent. It's going to be like that for X amount of time, and then it could go to a different rate. And it may be a higher rate. It may be a cheaper rate. Okay, we're still on slide number 3. The next long-term debt instrument is bonds. There are 3 different types. Okay, you have treasury, corporate, and municipal. First, let's establish by definition what is a bond. A bond is a long-term debt issued by a business or governmental unit and generally sold in 1,000 or 5,000 increments to a large number of individual investors. A bond is a long-term debt issued by a business or governmental unit and generally sold in 1,000 or 5,000 increments to a large number of individual investors. Okay. Now, one of the first types that we're going to talk about is a treasury bond. A treasury bond has another name. It may go by government. Okay, so a government bond or a treasury bond, they're issued by the U.S. Treasury and are used by the federal government to raise money. Now, sometimes you may also hear treasury bonds referred to as T-bonds. They have maturities of more than 10 years. That's treasury bonds. Treasury notes or T-notes have maturities of 2 to 10 years. And then treasury bills or T-bills have maturities of 1 year or less. So with the treasury bonds, they're broken down into 3 different types. You have treasury bonds or T-bonds. They have maturities of more than 10 years. Treasury notes or T-notes have maturities of 2 to 10 years. Treasury bills or T-bills have maturities of 1 year or less. So for an example, let's say for an example, you have a 20-year T-bond that was issued 15 years ago. A T-bond has a maturity of more than 10 years. Okay? Now, if you were given a 20-year T-bond that was issued 15 years ago, it only has 5 years remaining to maturity. Okay? But, although that may be the case, it's still classified as a bond and not a note. Because remember, the treasury notes have maturities, of 2 to 10 years. The bonds have maturities of more than 10 years. Okay? All right. The next type of bond is a corporate bond. Corporate bond is debt issued or sold by for-profit businesses as opposed to tax-exempt municipal bonds. Corporate bonds, basically, they're issued by investor-owned businesses versus municipal bonds, are issued by governments and government agencies other than federal. Now, corporate bonds generally have maturities in the range of 20 to 30 years. Okay. Okay, now with the municipal bonds. Municipal bonds are also called or known as muni, M-U-N-I, muni bonds. These are long-term debt obligations issued by states and their political subdivisions. Issued by states and their political subdivisions, such as counties, cities, toll, T-O-L-L, roads, R-O-A-D-S, or bridge authorities. Short-term municipal securities. Short-term municipal securities are primarily used for temporary cash needs. Primarily used for temporary cash needs. That's a short-term municipal. If it's a long-term municipal bond, that's usually the ones that's used to finance capital projects such as, for example, lands, buildings, and equipments. All right, now let's look at corporate bond types. Mortgage bonds. Mortgage bonds. These are bonds issued by a business. Bonds issued by a business that pledges real property as collateral. So these are bonds issued by businesses that pledges real property and businesses as collateral. So basically what that means is this. If for some unknown reason you didn't pay back the bond or whatever the case may be, you have pretty much put your property and building up as collateral, and in the event of a bankruptcy, a liquidation, or something of that nature, that's what they will get in exchange for you not paying back the bond. They now have, your property or your building because that's what you exchange as collateral to get in the mortgage bond. Debentures. Those are unsecured bonds. They have no lien against specific properties as security for the obligation. So basically the way these bonds are secured is by the revenue producing power of the corporation. Okay. Now let's look at slide 11.4, debt contracts. Pretty much this is where the rights of both the borrower and the lender are spelled out. So the contract between the issuer and the bondholder, those are called bond indentures. The contract between the person that issues the bond and the person that holds the bond, that's called bond indentures. So basically, that's where you kind of get into loan agreements and promissory notes. So loan agreements, promissory notes are simultaneously with each other. Okay, they're documents that specifies the terms and conditions of a loan. So debt contracts usually contain general provisions such as maturity, when the principal must be repaid, because remember we just talked about that. See, when you're getting a loan, that's really principal money to be paid back. All that other extra is the amount of interest over the period of time. So some things that affect your contract is how long you have on the loan, the type of debt you have in which you need a particular type of loan, and your interest rate, and your type of interest rate. So we're not just looking at 5.2%, 6.3%, but are we looking at a fixed interest or variable interest? Okay. Then you have what you call trustee designations. Well, let's go back up. We skipped one. Restrictive covenants. Restrictive covenants, by definition, is a provision in a bond, indenture, a provision in a bond, indenture, or loan agreement that protects the interests of lenders by restricting the actions of management. A provision in a bond, indenture, or loan agreement that protects the interests of lenders by restricting the actions of management. So basically, they kind of serve to kind of help protect, to make sure that you're being dealt fairly with your loan or your bond that you have. And it's really to make sure nothing detrimental would come to you when it comes to the creditors. So like, say for instance, it kind of helps them to, just like if they're going to lock you in on a fixed rate, then they have to honor that fixed rate for however long the maturity of the loan is, stuff like that. If you don't have a variable rate, they can't just go in there after so many years and decide to do this, that, and etc. So you have what you call restricted covenants. Then you have trustee designation, usually for bonds only. Trustee can be any, is usually an institution such as a bank. And they represent the bondholders and ensures that the term of the indenture, and remember what I said about the indenture earlier, is carried out. So basically, they're responsible for ensuring or monitoring the issuer, who would be the bank, and for taking appropriate action if a covenant violation occurs. That's the job of the trustee nation. Call provision, slide number 5. A call provision, by definition, is a provision in a bond, indenture, or contract, okay, that gives the issuing company the right to redeem or call the bond prior to maturity. So that's if the bond has 10 years, a call provision is a provision in the contract that gives the issuing company the right to call it back. In other words, it permits the borrower to redeem or pay back the debt prior to maturity. That's a call provision. So even though I may have a bond for 10 years, I don't have to keep it for 10 years. If I can pay it back in 5 years, 6 years, 7 years, then that's called a call provision. Now, sometimes call privileges are deferred. And the book gave a good example, like say for instance, if you had a 20-year bond that was issued by a healthcare facility in a given year, you wouldn't be able to call it back to 2024, which means that it has a deferment on it. Until that time comes, you couldn't call it back prior to its maturity date. Okay, slide number 7. The financial value of any asset. Asset means your assessment. It has to do with your cash flows. It has to. You got to be able to know as a manager where your money is going, and you got to tell your money what to do. Okay? Because money goes where we instruct it to go or where we tell it to go. Okay? Now, let's look at some other bond definitions. Things that you'll hear in relations to bonds. Let's look at those. Okay? So the very first one we want to look at is par value. Par value is pretty much the face value of the bond. Okay, so I pretty much have kind of already in the notes gave you some definitions of these different type of things. So these are just some particular features of a bond that I want you to be familiar with. Okay, so when you hear par value or just the word par, just know that's the face value of the bond. And it pretty much represents how much is being borrowed. We already know about maturity date. You know, that's the actual date in which the loan has to be repaid by that particular date. Coupon rate, that's the interest rate on the bond. And basically, you just take that rate, multiply it by the amount of the face value, and that's usually how you can get a payment. Is usually fixed. Those are usually fixed rates. And of course, slide number 9, maturity date. Just talked about that. New versus seasoned bonds. When a bond is issued, depending on what the current conditions are or the current rate is, that's usually what determines the overall value of how that bond changes. Okay? So a bond that you get now versus what you would have got 15 years ago, probably won't carry the same value as it would have back then, nor would it perhaps carry that same interest rate that it would have carried 10 and 15 years ago, because so much has changed since that time. Debt service requirements. Basically, this is where you learn what your total amount of debt is for the payments, including your interest expense that you're going to pay out over that period of time that you have the bond, and the repayment of your principal. All of that is pretty much structured over a set amount of time, whether it's over a period of 5 years, 10 years, 15 years, 25 years, 30 years. Now, I don't want you to worry about slide 11, 12, or 13. Those were just kind of some calculations on year to maturity. What I mainly want you to take away from that is on slide number 14, what a YTM is. And it's pretty much like your expected rate of return. So remember how in healthcare economics we talked about return on investments, like when you make an investment, what you expect to get back on it. So it works kind of similar with bonds. Bonds have a YTM, expected rate of return, assuming that, but now this is assuming that during the time period that you have the bond, no default occurs. So if a default occurs, you can't expect a rate of return on that particular bond versus when you first got the bond and there was no default at that present moment. You cannot expect it, okay? So a year to maturity on a bond is pretty much the expected rate of return on the debt security, assuming that you have no default. Okay? So like in your book, there was an example in a book of a company that had a bond for like 14 years remaining. So, a lot of times people hold on to bonds and then they kind of cash them in, so to speak, after they've had them for so long. Well, this particular company had one for 14 years remaining on one that they had. And at the time that they checked on it, at that given moment, it was at a selling price of $14.94. So if they wanted to know at a 5% rate how much they would be, they would pretty much just plug that into a financial calculator to kind of see what their expected rate of return would be on that particular bond. Okay. Now, that pretty much covers what I want you to take away from the class from chapter 11. I basically wanted us to talk about the different types of bonds. I wanted you to have a clear understanding of interest rate, principal, payments, just so you can be aware of that, what the expectations are if you have to have a bond. I wanted you to take away from the class information about loans and what you can expect if you need to borrow from a bank and get a loan. How does that work? How does contract works? What happens if you default? Do you understand about maturity dates and things of that nature? So I've covered what I wanted you to have from the actual class. I still want you to go and read chapter 11 because the book has some more examples of all those different things I just stated. I didn't give you all examples from the book. I only gave you one or two, but the book has more. Be sure that if you did not get the definitions from the recording as I was going through here, make sure you go back through the recording and get that, or you can go through the book and get your definitions that way. But do make sure you go back and review chapter 11. The slides for chapter 11 are in Doc Sharing for you to be able to print and have at hand for your information. Okay. So again, this concludes chapter 11. So we're going to go right on into chapter 12. Chapter 12 talks about equity financing and securities markets. I can tell you this is going to be very, very short. There's not a whole lot of slides tied to chapter 12. I just kind of want to mention a few things, okay? So, slide number 18, for-profit businesses. There are 4 ways in which those type of businesses are organized, okay? So, we're going to kind of briefly talk about each one. So the very first thing we have is what we call proprietorship. Very first one we have is proprietorship. So we know that for-profit businesses are those businesses where they depend on every single dollar coming in as a way of operating their business. They depend on that. Okay? They don't really get, you know, whole lot of government type money like that. So when they're proprietorship, by definition, this is a single form of business owned by a single individual. So you take a doctor's office, he's the only physician there, he has a proprietorship. He's his own physician, he runs that business clearly by himself, versus a partnership, by definition, is a non-incorporated business entity created by two or more individuals. Okay, and that's where you have two individuals who have decided, hey, well, you know, let's kind of do this together. Let's kind of create this business. So, you know, they may create their own healthcare business by themselves. Those are partnerships. Okay, let's look at corporations. By definition, corporation is a legal business entity that is separate and distinct from its owners and managers. A legal business entity that is separate and distinct from its owners and managers. I'm going to give you a few minutes to kind of finish writing that. All right, and then we have hybrid forms. Hybrid forms are designed to limit owners' liability without having to fully incorporate. So now hybrid forms are your organizations that are your LLCs, limited liability companies, PCs, professional corporations, and PAs, professional associations. And your LLPs, which are your limited liability partnerships. So basically, these are organizations that limit the professional liabilities of its partners. Those are like your different types of hybrid forms. Okay, so now let's kind of move a little bit and let's just kind of talk about some of the main individuals who have interest in corporations or businesses. First and foremost, I'm referring to stockholders. Okay, so on slide number 19, net income. You know, net income is what's generated once everything is paid out, belongs to shareholders. Other portions may be paid out in dividends or used to purchase stock. But stockholders have the rights and privileges to net income. They control the firm. Okay, let's talk about the different types of stock. Okay, different types. Most firms have what you call classified stock. Most firms have what you call classified stock. Okay, so by definition, let me give you what that is. This is a term used to distinguish between stock classes when the business uses more than one type of common stock. The term used to distinguish between stock classes when the business uses more than one type of common stock. So when I talk about classes, you have class A, class B, but they don't have like standard meanings. But these are just meanings rather. But these are just different type of classes of the different types of stock. So, you know, it may be a class A stock, class B. So to kind of give you a little bit about it. So like in the book, there is an example given to you. So there was a company, Genetic Research, who went public. Okay. When they went public, their Class A stock was sold to the public and they paid a dividend, but carried no voting rights for 5 years. In the Class B stock for the same company, it was retained by the organizers of the company, but it carried full voting rights. So depending on what class a firm may choose determines, you know, if you carry voting rights or if you have the rights to do this, or, you know, if this get retained or if that gets sold. So pretty much the firm's use of classified stock allows the public to take a position in the financial growth of the company. So in other words, a firm that does designate Class B as their share founder like most firms have no classified shares, but a firm that does could designate its Class B shares as founders, and Class A could be those shares that's sold to the public. But once you sell it to the public, it's like it carries no voting right. But if you get a Class B and share that with stockholders, those are the things that can be shared by the founder, not necessarily sold to the public. Okay? Equity in not-for-profit businesses. They have equity capital money, but it's not supplied by stockholders. Okay, so basically their startup equity in a not-for-profit, they get a lot of their startup equity from religious organizations, any type of government entity, and from contributions. And I put in the notes on slide 21 for an example, the Mayo Clinic. How do they stay ongoing, keeping their business operating? It comes from profits that they generate in. Again, contributions, and a lot of not-for-profit businesses, they write a lot of grant. They get a lot of grant money. Slide number 23. In all things, one of the most prominent implications of market efficiency to keep your business up and going. In all things, you got to understand pricing reflects that. So as an investor, you shouldn't look to beat the market, because the market is one of those things. It can be up, it can be down. You shouldn't be looking to beat it. Okay, what you should be looking to do is to stay at level with the market. You know, not let yourself start drowning or whatever the case may be. You can't beat it, but you ought to be competitive with it. So what make markets efficient? Slide number 25. Large companies, treasury securities, real assets are not efficient, such as real estate, and that's no, that's not efficient. What's efficient is those assets that you know that you've generated from, you know, stocks and bonds. You in a very large company, you got treasury bonds that are worth a lot, or you invest in a lot, and you know that's what make a market efficient. It's not real estate. Okay, so you buying up a bunch of property, that's all fine, well, and dandy, but you're not staying in business long enough to even make money while you in that property, so to speak. Okay, I'm on slide 25. What markets are efficient? All right, that pretty much concludes chapter 12. Short, sweet, to the point. I just wanted to give you a little, just a little information of what I want you to take away from the chapter as it pertains to equity and security markets. Again, make sure you read your notes. You can print the Doc Sharon notes in chapter 12. And then make sure you go back and skim through the chapters and read the chapters again. Pay very particular attention to the very first section of chapter 12, where it talks about the differences in the for-profit and the not-for-profit and the shareholder, and along with the different types of common stock. Okay, let's move into chapter 13. Again, very short chapter. Capital structure and the cost of capital. The very first thing I have listed on slide number 27 is two related concepts for you to consider. How much debt financing should you use in your business? And what's the cost associated with the business's capital? Capital being money. Okay, again, slide number 28. Very first slide I have up here is the funds that you use to finance your business, to keep your business up and going, is called capital. Capital meaning money. Can't run a business without it. Capital structure is the way in which your financing is mixed. This usually occurs on the right side of the balance sheet. Slide number 29, I just kind of put an example up here of capital structure as it pertains to risk and return for a for-profit clinic that utilizes, they're just a normal walk-in clinic. They got to have at least $200,000 to begin their operation. What they're expecting to produce in income is $50,000. So they have two alternatives. They can either do no debt financing, which means everything will be based on the equity they bring in, or they can at least do $100,000 of debt off of a 10%. Either way, that's a 50-50 mix for them. So do nothing, depend on all equity, or finance at least $100,000 at 10%. Now, when you are debt financing, when you debt finance, That allows more of your income to flow to your investors. And anytime your debt financing goes up, or shall I say increases on your return, that's called financial leverage. Financial leverage. So anytime you can take debt that you're financing and increase the return on it, you invested but you got a big return, you normally classify that as financial leverage. Now, of course, the greater the financial leverage, the greater the risk you take. That's on slide 31. The greater the amount of financial leverage, the greater the risk you take. Because a lot of times you get tempted as a business owner or as a manager, you get tempted and you get to seeing what you're getting back on a return. A lot of times you're tempted to want to invest more. So you have to be really, really careful with that, because you can add risk to a lot of decisions that you make. So to bag that up, 1132. Factors, this slide 32. Factors that influence business risk when you're uncertain about these three things here that I have listed. The sales volume. Are you producing the amount of sales at the volume you want? Sale pricing. Are you selling items at the price they need to be sold in order for you to be profitable? Uncertainty about cost. You have liability uncertainty. Then you have operating leverage. Those are factors that influence business risk. Financial risk is placed on owners when debt financing is used. Okay? So anytime you invest in anything, any debt that you bring in, and what you got going on, all of that is centered around financial risk. And we've talked about financial risk early part of the course. Okay? You take financial risk chances just with individuals coming to your facility, and you don't really know if you're going to get if you're going to get repaid back the service that you've invested into them, the time that you've invested in, the supplies and material that you've used on that particular person. You know you're going to get a portion of that, but you know that you're not guaranteed to get 100% of that. You take a risk with that. You take a risk when you allow an individual to come into your facility and they don't really have insurance. I mean, it's not like you can just turn them away, but you take a chance. When you bill a patient, you don't know if that patient is really going to pay that bill. You don't. So you take a financial risk with that. Slide 35. Factors that influences your cost of capital, money. Market conditions, the first thing I have listed there. When the market crashes, we all feel that. Because when market crashes, that affects interest rates. If you fix into one, you fix into one. But if the market is up and down and you need to go and borrow money, or you're trying to make an investment, or you're trying to do, try to get something big back on the return, you got to understand market conditions affects those kind of things. So business risk is affected by how you operate your financing. That's operating leverage. Financial risk is reflected or affected by debt financing that you're using. It's the difference between the two. It's one thing to invest the money and operate the finances, but it's another in operating the actual business itself. Okay? That does it for chapter 13. Short, sweet, and to the point. Again, make sure you read through the chapter. Read through chapter 13. Make sure you go and get your notes out in Doc Sherry so that you can have those. And that pretty much does it for chapters 11, 12, and 13. This audio will be uploaded in the student portal for you to go back and review later if needed. And again, your notes are in Doc Sharing. Thank you.